Welcome back to Global Macro Pulse. We are doing a deep dive today into um a really profound structural divergence that is flashing across our trading desks right now. It is the kind of dislocation that fundamentally redefines how you should be looking at your portfolio allocations. We are jumping into a market reality that seems entirely counterintuitive on the surface. We have severe historic escalation unfolding in the Middle East right now. Missiles are flying, strategic choke points are under direct threat, and yet gold has just violently sold off.
Yeah, violently is the right word.
I mean, we are talking about a massive $300 plunge in a single session, breaking all the way down below $5,090 an ounce. For anyone looking for a safe haven, the traditional playbook is officially broken.
It really is broken. The tape absolutely does not lie, and the numbers flashing right in front of us are brutal for anyone caught off guard relying on old assumptions. We are seeing the US dollar index, the DXY, muscling its way up to 99.05. Simultaneously, the 10-year Treasury yield has spiked to 4.14%.
Let's pause right there to make sure we are all on the same page for this deep dive. Because seeing those two numbers spike together tells a very specific, almost alarming story about systemic risk.
Right. Think of the US dollar and the 10-year yield as the gravitational center of the global financial system. When the yield on government bonds spikes like this, it means the government is paying you more just to hold their debt, which is considered risk-free. When you look at those basis points moving in tandem with a massive dollar rally, it tells a very specific quantitative story. The headlines are screaming about geopolitical panic, but the bond and currency markets are signaling a severe, immediate liquidity squeeze.
Capital isn't fleeing to gold right now to hide, it is fleeing to cash.
Exactly. It is fleeing to cash and short-term government debt because institutions are desperate for liquidity.
So we are witnessing a high-speed collision between systemic risk in the physical commodity markets and a brutal liquidity cycle in the broader financial system. The physical world feels like it is breaking apart, but the financial plumbing is violently tightening. To get a handle on this, we need to dissect the whipsaw we just saw in crude oil, look at the massive global expansion of the AI chip war, and break down what the impending U.S. labor data means for your allocations.
We definitely need to start with energy, because the physical supply shock we are tracking is textbook systemic risk.
The geopolitical headwinds are just staggering right now. The Strait of Hormuz is under direct threat. We are seeing the IRGC outright claiming the authority to block U.S., European, and Israeli vessels from transiting. Add to that a confirmed drone strike on the USS Lincoln aircraft carrier, and the fact that Iraq's oil storage facilities are completely maxed out.
And that maxed out storage is forcing Iraq into a catastrophic 3 million barrel per day production cut.
Which is massive. Historically speaking, taking 3 million barrels a day offline in the middle of a military conflict is the exact cocktail that triggers a generational energy crisis. So, if the Middle East is facing this level of escalation, the textbook says oil should be skyrocketing. Why did crude just violently reject that upside?
I'm glad you brought that up, because looking at the immediate price action and the volume divergence we are tracking, the market is completely rejecting the doomsday scenario. Yes, West Texas Intermediate WTI crude surged and tested that key resistance level at $82. That is the ceiling our trading algorithms were watching. But look at what happened next. It violently rejected that level and closed back down at 78.4.
Brent crude barely held near 84.
Right. You just don't see that kind of massive technical rejection during a true supply panic unless there's an overwhelming counterforce pushing it back down.
And the counterforce here is government intervention, because the headlines alone should have pushed it to $90 easily.
In this case, we had two massive fundamental data points hit the wires that instantly repriced the curve. First, the U.S. executive branch stepped in and announced Navy escorts and direct insurance provisions for crude transport out of the region. That immediately lowered the panic premium for physical shippers. Second, and this is heavily impacting the quant models right now, the White House is preparing to announce specific, targeted measures this Thursday in Washington, D.C., U.S. Eastern Time, to directly intervene in the oil futures market.
That potential intervention is where things get philosophically fascinating to me. When a government threatens to step into the futures market, they are essentially threatening to short the market with unlimited pockets. But we cannot ignore the broader paradigm shift happening in global energy balkanization. And just to be clear for you listening, when we talk about the political figures involved here, Trump, the current U.S. administration, the Iranian leadership, we are not taking any political sides. We are strictly looking at the market mechanics. But the U.S. administration's actions go far beyond short-term price suppression.
How so? Because from a strict trading desk perspective, Price suppression is the only thing the algorithms care about today.
True, but look at the friction being introduced globally. We're seeing the executive branch actively cutting trade ties with Spain over a perceived lack of cooperation. We are watching Trump directly insert himself into Iran's internal succession planning, publicly stating he will not accept Khamenei's son taking over as supreme leader, and openly encouraging Kurdish offensives. As someone who looks at the macroeconomic big picture, I see a permanent balkanization of the global energy market.
You mean a complete fracturing of the supply chains?
Exactly. Even if the U.S. artificially suppresses the paper price of oil for a month or two with futures intervention, the sheer friction of these fractured geopolitical relationships is going to permanently raise the structural floor on the physical price of Brent crude. You simply cannot price out this level of systemic friction forever.
That is a fair long-term thesis. But from a strict quantitative perspective, the immediate threat of White House futures intervention has completely crushed the volatility skew.
Explain that for the listeners who don't trade options.
Sure. The volatility skew measures how much traders are willing to pay for options that protect against massive price spikes versus price drops. When the government signals they are going to step into the paper market to push prices down, it destroys the demand for upside protection. It caps the near-term upside entirely. What we saw at the $82 mark was retail investors getting trapped at key resistance levels. They bought the geopolitical headline breakout expecting oil to go to the moon, and they got instantly flattened by institutional algorithmic selling ahead of the Washington announcement. If you were trading the headlines right now without understanding the market mechanics, you are basically acting as exit liquidity for the smart money.
That is a harsh reality for retail traders, but it perfectly transitions us into the absolute carnage we are seeing in the precious metals market today. The gold collapse is the ultimate manifestation of this liquidity cycle tightening.
Carnage is the exact right word. We saw a $300 flush. Spot gold was hammered down 4.39% to settle at $5,088 an ounce. Silver took an even more savage haircut, plunging over 8% down to 82.06. And if you want a perfect mechanical indicator how extreme the volatility was, the CME actually stepped in and lowered margin requirements for both gold and silver futures.
Which is incredibly counterintuitive. Normally, when a market gets crazy volatile, exchanges raise margin requirements to force traders to put up more cash, which cools the market down. Lowering margins during a crash is a huge red flag.
It is a paradox, yes, but it is a classic mechanical response to extreme stress.
Yeah.
Lowering margins means the exchange is desperate to inject liquidity back into a completely frozen order book. They are trying to make it cheaper for traders to step in and buy. But the price action itself tells us something much deeper. This was not a fundamental rejection of gold as an asset. The volume indicates massive institutional margin calls hitting across the board.
Just to break down a margin call quickly, it is essentially when your broker demands you deposit more cash to cover potential losses in a leveraged position.
Exactly. If the broader stock market bleeds and yields spike, hedge funds are forced to liquidate their winning gold positions just to meet margin calls on their losing trades elsewhere. They don't sell what they want to sell. They sell what they can.
That makes total sense, and it explains the sudden, violent plunge. But looking at the broader central bank flows, there is an unprecedented shift in behavior that is amplifying that downward pressure. Over in Warsaw, operating on Central European time, the Central Bank of Poland is actively looking to sell its gold reserves, and the stated purpose is explicitly to fund national defense programs.
That is a staggering shift in flow data. For the last decade, central banks have been the foundational bid under the gold market. They have been accumulating it relentlessly.
Right. And what Poland is signaling here is a textbook case of fiscal dominance. Fiscal dominance is when a country's immediate survival budget completely overrides its long-term financial strategy. We are watching sovereign nations transition from hoarding gold for long-term financial security to liquidating it for immediate physical wartime survival. When sovereign wealth is mobilized to buy literal munitions, the traditional macroeconomic models for how we value gold completely broke down.
And while that fiscal dominance plays out on the sovereign level, the bond market is acting as a massive gravitational pull on private capital. The 2-year Treasury yield is pushing 3.59%. When you can get that kind of risk-free yield on the short end of the curve, holding a non-yielding asset like physical gold becomes incredibly expensive from an opportunity cost perspective. Yields are systematically stripping the haven premium right out of the precious metals market.
And those macro headwinds are being amplified by highly unusual physical market dynamics. U.S. officials are currently brokering massive 1,000-kilogram physical gold trades with Venezuela. Setting aside the politics of that, When you have the U.S. government facilitating the movement of literal metric tons of sovereign gold to manage diplomatic or economic pressures, you are fundamentally altering the global physical supply and demand balance. It creates a sudden overhang of physical supply in the market.
It is a perfect storm for precious metals right now. But the systemic risk is not just in commodities and government bonds. We have to talk about the structural risk flashing in the equity markets, specifically the global expansion of the tech war.
The semiconductor sector is right in the crosshairs. Legislation proposed in Washington, D.C., U.S. Eastern Time aims to expand artificial intelligence chip export controls globally. Previously, the market had priced in restrictions targeted at specific rival nations. This new proposal means heavyweights like NVIDIA and AMD will require explicit federal licenses to ship their top-tier hardware anywhere in the world.
The implications for that are massive. The total addressable market, which is the maximum potential revenue a company could possibly generate, just got fundamentally bottlenecked by regulatory red tape. If NVIDIA has to wait 6 months for a federal license to sell chips to a data center in Europe or South America, their cash flow slows to an absolute crawl.
It is a total paradigm shift for global technology infrastructure. You are taking the most critical growth engine of the global economy, AI compute power, and putting it under the direct discretionary control of the U.S. government. What does that do to the technical charts?
The technical damage is already severe. Look at the immediate fallout today. AMD and ASML are down around 4%. Intel gave up 5%. Micron got absolutely obliterated with an 8% drop. For you listening and managing your own allocations, you need to watch the 200-day moving average on these tech stalwarts.
The 200-day moving average is essentially the long-term heartbeat of a stock. It smooths out the daily noise and shows you the macro trend.
Precisely. It is the line in the sand for institutional algorithmic trading. If a stock falls below its average price over the last 200 days, it signals that the long-term trend has broken. We are dangerously close to breaking structural support across the entire semiconductor complex. This is not just a fleeting geopolitical headline. This is a fundamental threat to global forward revenue streams. When you effectively slice the global market in half with export controls, the discounted cash flow models have to be completely rewritten.
And the East is not sitting idle while this happens. The immediate response in Asia is profound. We are seeing Chinese tech behemoths like Alibaba, Tencent, and ByteDance rapidly accelerating their rotation toward domestic suppliers to bypass this impending global storage chip shortage. They are entirely decoupling their supply chains.
And we are seeing the fiscal support for that decoupling happening right now.
Right. Concurrently, over in Beijing, local time, the two sessions legislative meetings have just set a 2026 GDP growth target of 4.5 to 5%. And they are not just setting arbitrary targets, they are backing it up with immense liquidity.
The People's Bank of China just injected an 800 billion RMB reverse repo to stabilize their financial system.
For those not deep in the banking plumbing, a reverse repo is basically the central bank loaning a massive amount of cash to commercial banks on a short-term basis to ensure the financial system doesn't freeze up.
Exactly. It is a massive shot of adrenaline to keep the markets functioning. But what we are witnessing as a result is the real-time creation of a completely bifurcated global tech ecosystem. One hemisphere running on U.S. licensed silicon and another racing to build a completely independent domestic architecture.
Did that 800 billion RMB injection actually lift the Chinese tech sector, though?
That is the fascinating part. The liquidity injection was massive, but if you look at the local A-share stock market reaction, it was brutally selective. Money did not just blindly flow into the broader market. We saw capital aggressively fleeing the vulnerable tech and storage chip sectors and dumping straight into domestic grid infrastructure and micro-LEDs. Stocks in the smart grid spaces were hitting 20% upside limits, while memory chip makers were getting hammered down 10%. The domestic market in China is loudly signaling that they know exactly which sectors are insulated from Washington's export controls and which ones are trapped in the crosshairs.
So synthesizing all of these data points we are tracking today, we have covered a global fracturing of energy markets, central banks pawning their gold reserves for weapons, and a completely divided global technology ecosystem. Where does this leave the broader economy? Because to me, it looks like it puts the Federal Reserve in an impossibly tight box.
It absolutely does. Look at the central bank commentary hitting the tapes from Fed officials like Kashkari, Williams, and Schmidt. The consensus is shockingly hawkish. They are all explicitly signaling that the geopolitical war premium and the sticky inflation risks are effectively taking rate cuts off the table for 2026. Williams specifically cited the spillover effects of the Iran conflict on foreign markets.
Which makes perfect sense. If shipping lanes are blocked, it costs more to move goods. That pushes inflation up. So when central banks are forced to maintain high interest rates to fight supply chain inflation, right as global growth is slowing down due to these exact same geopolitical frictions, you have the textbook definition of stagflation. Stagnant economic growth combined with high inflation. It is the absolute worst-case scenario for a central bank.
And the macroeconomic data is already confirming that the deterioration in growth. We need to look ahead to the upcoming non-farm payrolls release, dropping later this week in Washington, D.C., U.S. Eastern Time. The expectations are sitting at a dismal positive 60,000 jobs. That is a massive drop from the previous 130,000. Unemployment is expected to hold stubbornly at 4.3%.
Which is not great for the consumer side of the equation.
Not at all. And if you need a leading indicator to show where things are headed, initial jobless claims just ticked up to 213,000. The labor market is absolutely cooling. So you have inflation that the Fed cannot ignore because of the supply shocks, and a labor market that is beginning to crack under the pressure of 4.14% on the 10-year yield.
So bringing this all home for you, the investor, who is trying to figure out what to do with this information, your actionable strategy has to respect the shifting liquidity cycle. The market spent the last 2 years praying for aggressive rate cuts to bail out risky assets. The proprietary data flashing today suggests that dream is over. If central banks globally are prioritizing sovereign defense spending and supply-side inflation control over economic growth, your portfolio must adapt. You have to hedge against sustained elevated yields on the long end of the bond curve. The era of cheap capital rescuing overvalued equities is suspended.
From a tactical standpoint, it comes down to extreme discipline. Watch the basis points on the 10-year Treasury. It is the center of gravity for every asset class right now. If it keeps rising, it will drag everything else down. In the equity space, do not try to catch falling knives in the semiconductor sector. Wait until the global licensing rules from Washington are fully crystallized and analysts have actually priced the damage into the forward earnings estimates. And regarding oil, let the price action be your guide. Trading volatile geopolitical headlines against direct, telegraphed government intervention in the futures market is a losing quantitative strategy. Respect the algorithmic flows and respect the data.
It really is a profound realization to see how quickly global market psychology shifts. Just months ago, the singular focus was on when the Fed would pivot to save the consumer. Today, we are watching European nations liquidate their gold wealth to arm themselves, and the world's largest tech companies being walled off behind national security legislation. It really makes you wonder, if sovereign nations are actively trading their gold reserves for munitions today, what happens to the perceived value of our fiat currency when the dust finally settles on this fractured global economy? Something to keep an eye on in your own portfolio as these macro headwinds develop. Stay ahead of the curve. This is Global Macro Pulse.
Disclaimer, not financial advice.